Okay, so I think we are good to start now. Good morning, everyone. On behalf of the Spanish Chamber of Commerce in the UK, I'd like to give you a very warm welcome to this webinar on the topic how UK and Spanish multinationals can optimize transfer pricing and international tax outcomes in a turbulent global economy. Just a quick disclaimer that we will be recording this session. Just so you know, all the attendees. Today, we are delighted to be joined by PKF Attest and PKF Littlejohn. PKF is a global network of accountancy and business advisors located in over 150 countries with over 21,000 professionals worldwide. PKF Attest have office across Spain, and PKF Littlejohn are the London representatives of PKF. Tax can be complicated, and even more when you operate cross-border. Understanding the impact that this has on your business, particularly in today's turbulent economy, is crucial. I'm pleased to say that today we have with us a panel of 3 tax experts from PKF, Farhan Asim, Catherine Hayes from PKF Littlejohn, and Jesus González Ruiz Jarabo of PKF Attest, who regularly work together to support their clients in both the UK and Spain, and who will share some of their insights with us today. Thank you very much. We hope you enjoyed today's session, and if you have any questions, please write them down in the Q&A function, and they will be answered at the end of the session. And now over to you. Thank you very much for joining us today.
Thank you, Alicia. So I'd just like to introduce myself. I'm Farhan, TP Director at PKF Littlejohn.
Hi, everyone. I'm Catherine Hayes. I'm Corporate Tax Partner here at PKF Littlejohn in Canary Wharf in London.
Good morning. I'm Jesus. I'm International Tax Partner here at PKF Attest in Madrid.
Okay, so I'm sure you're all very excited. Let's start with very quickly outlining what we're going to be covering today. So we're going to start off looking at some of the international tax aspects, which is going to be primarily discussed by myself and Jesus. And then Farhan's going to move on to transfer pricing. So headlines for international tax. We're going to quickly look at how taxing rights arise, both in the UK and Spain. We'll talk around tax residence and permanent establishment. We'll have a little bit of a look at how location of employees and commercial models actually drive a tax outcome. And then finally, we'll talk about the benefits of having an aligned business and tax operating model.
Thanks, Catherine. So on transfer pricing, I'll talk about, well, what transfer pricing is and how it applies to UK and Spanish multinationals. I'll talk about the difficult economic conditions we're clearly experiencing and how that's impacting inter-group pricing, how companies can manage that to achieve better tax and TP outcomes, and also just the wider commercial benefits of a robust tax and TP compliance.
Okay, so let's kick off. So what creates taxing rights in the UK and Spain? I'm sure most of the people on this call will have a level of understanding about these aspects already, but the UK is not uncommon. So in line with most other countries, including Spain, the UK is going to seek to tax you if the source of income is within the UK and if we've got a taxpayer who is resident here in the UK. So generally, if you're a UK resident taxpayer, you're going to be liable to tax on your worldwide income. And importantly, if you've got another source of income in another country, so in addition to paying UK tax on that, you might be subject to tax on that same source of income in another country, creating what we all know a double tax charge. So hopefully most of you are familiar with the concept of the double taxation agreement, the double taxation treaty. So the concept of this is that as a result of it being in place, you're going to avoid or reduce your exposure to double taxation. So generally, how does a DTA operate? Well, it's going to provide either an exemption, so that means a particular source of income is only taxed in one country, or it will generate a credit. So that will give one country a primary taxing right and it will require the other country to provide a credit for the tax that you've suffered in the other country. So important point, primary taxing rights are driven by the residence of the taxpayer. And if you are in a position whereby you're considered to be resident in both countries under domestic law, we have a concept known as the tiebreaker clause, and this is effectively a provision which is inbuilt into the DTA, which will force a determination of the residency under the terms of the agreement. So for those of us that read DTAs, you'll know that they contain a number of articles, and Jesus is going to talk briefly over some of the articles that we see in DTAs.
Yeah, thanks, Catherine. As Catherine was saying, first thing to determine when looking at the double tax treaty is whether you are tax resident in one country or the other one. Second, you will have to look which kind of income you are obtaining in that other country. And you will have to look whether such income fits within any of the different categories established in the double tax treaty. So you will have to determine whether your income qualifies as a capital gains, or as a royalty, dividend, interest, or business profit. And the treatment of each one of those categories might be different according to the provisions of the double tax treaty. And basically here we're speaking about withholding taxes in the sourced income jurisdiction. Then third important thing to determine also is whether you are acting or not through a permanent establishment. And this is particularly important when you are obtaining income which qualifies as a business profit, because such business profit would be effectively taxed in that other jurisdiction, contingent on whether you are operating or not through a permanent establishment. So for instance, let's say that you conclude that you're a UK tax resident entity, also that you're obtaining, let's say, income in Spain, that such income falls under the category of a business profit, then you should determine, okay, I'm deemed to have or not a permanent establishment in Spain. If the answer is yes, then such business profit or the profits allocated to such permanent establishment would be taxed in Spain. Spain would have the taxing rights. Otherwise, if you are not acting through a permanent establishment, then such business profits wouldn't be taxed in Spain. So, Catherine, perhaps we can move to the next slide.
Well, before we go, I just put a cheeky note on the slide about Brexit.
Sure.
I guess if you're here in this webinar and you're in business, I've got no doubts that Brexit caused you a massive headache. I guess from an advisor perspective, we could say the same, but it also meant we had a lot of work to do. But in the concept of what we're talking about today, just to keep a key point, I'm sure most of you are aware of this. Previously, prior to Brexit, when we were part of the EU, when we were looking at the application of the DTA, so for example, looking at application of withholding taxes, we could previously go down a route of using one of the EU directives in order to claim an exemption from the withholding taxes. We now can't do that. So we now have to look at the relevant DTA. So between the UK and Spain, for example, in order to look at what that actually states that we can or can't do. So yeah, slightly different position post-Brexit. So moving on to taxing rights, and we're going to start with the taxation basis in the UK. So the first point, if you're incorporated in the UK, so we've got an entity that's treated as UK tax resident, important point, that's going to be subject to tax on its worldwide profits. And of course, that's unless it's deemed to be tax resident in another jurisdiction under double taxation agreement, in which case we're talking about a different jurisdiction. If we are deemed UK tax resident, again, taxable on our worldwide profits. if we create a permanent establishment here in the UK, and we'll talk about that in a little bit more detail afterwards, we have to assess the profits attributable to that PE that we're going to pay tax on here in the UK. What about non-UK resident companies? So where we've got no PE, for example, they're going to be subject to tax on certain different types of income and gains which are driven from UK property. So for example, that would be any trading profits which we attribute to dealing or developing land here in the UK, any gains that arise on direct and also certain indirect disposals of UK property, and profits of a UK property rental business are also going to be liable to UK taxation. Payments of interest and royalties to non-UK entities. I've already talked about that briefly on the previous slide. So the application of potential withholding taxes on those payments. And then finally, any other UK source of income is also going to be subject to tax here in the UK. Okay, Jesus, I'll hand over to you for the Spain taxation basis.
Thanks, Catherine. So basically, same principles apply. So I would say it's the other side of the same coin. So entities which have been incorporated in Spain or who have its mercantile domicile here, or individuals resident in Spain. Those are people residing more than 183 days, or when your spouse and underage dependent children live here. And the third criteria would be when the main source of your economic interests lie in Spain. Also, permanent establishments, which would be deemed a fixed place of business. As Catherine has said, we will look deeper into the permanent establishment concept later on. Let me just say that three main ideas. One is that the permanent establishment is a purely tax concept. Second, that sometimes it's not a clear-cut issue, and we have to look into the commentaries to the OECD Model Tax Convention or administrative pronouncements to determine where, or to conclude where permanent establishment exists or not. And also important to mention that you might have a permanent establishment for corporate income tax purposes, and therefore would be taxation rates in Spain. But there might not be a permanent establishment for a VAT perspective, and the other way around. So those are different concepts. And then mentioning other kind of income also that could be sourced in Spain, aside from the ones that Catherine have mentioned, salaries and wages derived from unemployment, which has been carried out in the other contracting state, would be typically taxed in the state of residence. Nevertheless, under specific circumstances, such salaries may be taxed in that other country where such a specific wage or salary derives from. And on the other hand, in the case of for instance, of director fees, so let's say director fees derived from a UK resident as a member of the board of director of a Spanish company, may be taxed in Spain, or vice versa. So Catherine, that's all from my side.
Okay, so let's move on to tax residence. So how do we look to ascertain tax residence from both a UK and a Spanish perspective? So I'm going to start with incorporation. Again, hopefully many of you on the call today will understand this point. There's a common misconception that when a company is incorporated in a particular jurisdiction, such as the UK, such as Spain, that it's automatically tax resident there. And that's a potentially incorrect position, depending upon the facts and circumstances. So from a UK perspective, what do we need to think about? So we need to look at the place of effective management of that company. and ascertain, is that in the UK or is it somewhere else? And that's an important point that we'll talk about that a little bit more in a moment. And also, if we've got a position where we've got deemed residence is in a country, which we ascertain under a tiebreaker clause in a double taxation treaty. So they're two key points that you have to consider when looking at this from a UK perspective.
Okay, from a Spanish perspective, there are three criteria. Two of them, the more formalistic. One of them is whether the entity has been incorporated under Spanish law, and the other formal criteria is if the registered office of the company is located in Spanish territory. Then, as Catherine was explaining, from a UK perspective, also in Spain, you have to look at the place of effective management and whether if such effective management is carried out in Spain. And in fact, that's the tiebreaker in case of a conflict in terms of tax resident of an entity. You have to look into such place of effective management. Then also in Spanish law, there's an anti-abuse provision for entities that would be located in a low tax jurisdiction or a tax haven. Then such entity would be deemed to be tax resident in Spain if its main assets would be located in Spain, or rights exercises in Spain, or again, when its main activity would be carried here in Spain. So unless in this particular case, unless the entity would prove sound business reasons, and that if its effective management takes place in such low tax jurisdiction, unless that happened, it would be deemed to be a Spanish tax resident entity. And if we move to the next slide, please, Catherine, and elaborating further on such tax resident, as we were saying, in Spain, we have two formalistic criteria, which is the place of incorporation, or whether the registered office is established. But as I was saying, if there's a conflict, the tiebreaker is to determine whether the effective management effectively takes place. Which is considered, or what should we look at when determining which is the place of effective management? Well, it's the place where the full range of management and strategic decisions take place. So here it's a concept that has to do with the central management and control, effective control of the company. Such place of effective management must be made or must be determined according to the facts and circumstances revealed in each case. It's true that sometimes it's an, let's say, undefined legal concept. So its practical application is sometimes difficult. And it's important also to note that such central management or key strategic decision center is not the day-to-day management, and should be actually distinguished, let's say, from the day-to-day running operations of the company. It's actually a matter of control and strategic decisions. From a practical standpoint, if Spanish and probably UK authorities, when arguing if one entity should be treated as an UK or Spanish tax resident, they would try to argue things such as were the directors of the company are actually exercising their control, if such directors are based in Spain or in the UK. And also, on the other hand, they could argue that people other than the directors who actually are based in UK or in Spain are actually exercising such key decisions. So again, tax administrations would pay special attention to the place where the board of directors hold its meetings, even the place where the directors join, let's say, virtual meetings by telephone or video. I would also say that to the extent that all the board meetings will take place during the year in one single jurisdiction, that would definitely help to ascertain the tax residents in such particular jurisdictions, in comparison to a setup where the board meeting is celebrated in different places. And of course, the director's residence is another key aspect that the tax administration would look at. So, Catherine, I'm not sure if you have something to add in this regard. If not,
Yeah, well, I think it's similar from a UK perspective, and I guess we're all living in this world now. In fact, we were living in it before COVID, but in this post-COVID world now, where everybody's got slightly different patterns of working, we're seeing it more and more frequently. So you often find a global spread of your key decision-making people, and that is an important concept from a tax perspective. And sort of, I guess the tax world is sort of slowly coming up to speed with the way that we do business these days. But from a business perspective, you have to think about this, and you have to have your corporate governance in line and updated indeed when commercial's positions change, because you need to identify where you've got a risk particularly, or where you've got an opportunity, depending upon where you've got key people and things are taking place outside of the home country. Another point as well is, of course, we're also now in a position from a tax perspective. We're actually in some of the DTAs, what you're finding now is there's a mutual agreement procedure which is being brought in between tax jurisdictions. So sometimes you can be in, let's call it a grey area, where maybe you're not clear as to who has the rights. And there are arrangements now where you can go to tax authorities and you can seek agreement with them as to what the correct position is. Okay. So permanent establishment, I'm sure one of your favourite terms if you know about tax. So broadly here, this is the same for the UK and Spain, and of course both the UK and Spain are following effectively what the OECD Model Tax Convention says in terms of this. So important questions: do we have a fixed place of business through which the business of the company is wholly or partly carried on? I'm sure you've seen this a lot. What does that mean? Have we got a place of management? For example, so if we're looking at C-suite individuals and they're located outside of the home country, what does that mean? Got an office, a factory, a workshop, and there's also some specific rules when it comes to natural resources businesses and also those involved in construction. And then we've also got the habitual agent test. So is there an agent who is habitually concluding and indeed negotiating contracts on behalf of the home jurisdiction in another country? So again, commonly, I guess this might be salespeople where you've got a global sales force and they are, let's say, traveling across Europe, for example, and you have a potential exposure there where you're triggering this PE obligation in other countries. So you have to keep on top of that in terms of the movement of people and what they're actually doing. Jesus, do you want to add anything on permanent establishment?
Not really. I mean, dependent agent clause that probably everyone is familiarized with. So if you have someone on site that can conclude contracts on your behalf, then you would trigger PE. That wouldn't be the case in the case of an independent agent. And then also add that if you have a building site, a construction project, would constitute a PE if it lasts more than 12 months.
Fine. Okay. So what does all this mean? Well, we've just put a bit of a scenario up here on the slide just to talk about, to try and bring out some of the points that we commonly see. So, of course, I think most of you will probably be aware that the corporate income tax rate in Spain and the UK is currently the same. So it's currently at 25%. So some of you might be thinking, well, what's the point of this discussion? But I really want to illustrate this. So in this scenario, I've put on an Irish holdco. So the rate of corporate income tax in Ireland is, of course, lower. So it's currently at 15%. So let's say in this scenario, Irish holdco has the group IP and all the customer contracts are with Irish holdco. And therefore, on the face of it, we've got a revenue flow into Ireland where we're attracting that lower rate of corporate income tax of 15%. Irish holdco owns UK Tradeco, which in turn owns Spanish Tradeco. In terms of employee presence, so where are the people? We've got a large workforce in Spain, and they are providing services up to the holdco. We've got some people in the UK, but not many, equally providing services up to holdco. And we've got also a small employee presence in Ireland. And we've also got some debt financing being pushed down from topco through to the trade co's. So I thought we'd just talk about this at a high level in terms of the sorts of things that we need to think about. Jesus, so pass over to you if you want to start.
Well, of course, starting with the basics, you will have to look at local taxations in each one of the jurisdictions. I would say direct taxation, but also indirect taxation aspects. So in terms of VAT, any VAT impacts, are you able to recover such VAT fast? Then on top of that, what we see here is, let's say, cross-border transactions. So we have the loan, such loan, and probably Farhan can also explain, but should be established at an arm's length standards, and there should be probably an interest, and such interest, it's income derived in that other state. Such income, we will have to look if there's a withholding tax. So again, we will have to look in the most optimal way to structure that, so there is no or let's say a reduced impact from a withholding tax perspective, according to the treaties. Also to see how such tax eventually paid abroad can be deducted or exempted, so there's no double taxation. Also, we have services there. So those are the kind of aspects that we should look at. Farhan, perhaps from my transfer pricing perspective also.
Sure. Thanks, Jesus. So I would just elaborate on the point Jesus made. Clearly, the loan, it would be arm's length, so you'd probably look at the creditworthiness of the borrower, the purpose of the funding. Clearly, you'd want to ensure that you're not running into any cap limitations or interest restrictions in borrowing entities. Similarly, for services, you'd have to understand clearly what's the nature of the services, how important they are in the context of the group. Clearly, there might be an incentive here to park more profits in the Irish holdco, subject to lower tax. But if you've got significant people functions and key value drivers outside Ireland, namely in the UK and particularly in Spain, given there's a substantial employee presence, that would clearly have a significant impact, because the ability to do that could be restricted under transfer pricing rules. So in the context of any multinational, it's always important to look behind the legal form and just understand clearly where are people, what are they doing, how do they interact, and what's being exchanged and at what price. And that really flows right through to financial statements and tax reporting. Back to you.
Okay, so hopefully that gives you a flavour of sort of some of the things that you have to think about.
Yeah, Catherine, perhaps I will just add also to look at to avoid potential cash trap scenarios. So also to see how the flow of funds is going to go, and how such funds are going to go are going to be streamed from top down or down to top.
Definitely. Okay, so how do you manage risks as a business? We've already sort of talked about some of these things, but let's just put them in one place. So virtual meetings, they're happening all the time. I mean, they're certainly happening now. How often do they occur? Are you monitoring where your key people are when they're dialing into those meetings, and what decision-making processes are being undertaken as part of those meetings? It's quite important. Where are your sales staff? Do you know? Maybe with sales staff, it's more common that you know where they are. But even if you look at non-sales staff, you know, in the world that we live today, the number of clients that come and talk to us and say, we don't know. Somebody phoned us and they've been in, I don't know, Indonesia for 2 months, fulfilling their duties. And businesses sometimes just don't know where their staff are based, and it's quite important to be on top of that. How much influence do your shareholders and stakeholders have on the board? Are you thinking about that aspect? And where are they located when they're exerting such influence on the board? So you need to think about this. Jesus?
Yeah, also following with practical recommendations, just mentioning a couple of them. So, for instance, keep full and accurate minutes of each board meeting, including details of attendees, time and place in which it effectively has taken place, of the decisions we were actually made. As mentioned, if such meetings happen in the same location, definitely helps to avoid discussions. Also, we recommend the majority of the directors to be based in the jurisdiction in which we intend the company to reside. Of course, we must be careful that our operations in a foreign jurisdiction doesn't trigger a PE, if we don't want to trigger such PE. And for instance, also when discretionary powers would have been delegated to any person, such powers should ideally relate only to day-to-day affairs, and should not include the ability to make key decisions. So just to avoid these discussions in terms of tax residence.
Okay, so Jesus is now going to cover some of the key benefits of having this aligned business and tax model.
Yeah, very quickly. So we leave some time to Fahan to cover his topic. Yeah, I mean, at the end of the day, key thing here is that before doing business, or even at one point in time, companies should revisit their the business operational model and determine if it's such model is best set up both from an operational and tax perspective. So here we should look at things such as how the supply chain is being structured, if it makes sense from an operational, but also from an operational perspective. Also, as we were saying, where the key management decision-making process is actually taking place. Also, where the key assets of the business should be located, or which entity should own such assets. Who should be signing the contracts with suppliers, with customers. Also, and all of these aspects in connection to impacts, of course, from corporate income taxation, from potential tax benefits you can apply. Also, from a VAT perspective, to ensure that it's effective in terms of let's say cash management, even customs duties or withholding taxes. So again, such operating model and different tax impacts go hand in hand, and it's key to have a look at it and try to establish a efficient setup from both sides and considering both worlds. Therefore, it's important to establish where you set your functions, your risks, your assets, and also I would say that this is especially relevant nowadays, considering the current challenging landscape in terms of also of transparency, also of the base, of the BEPS initiative, so base erosion profit shifting initiatives. So all of these topics, in of course having an operating model which is adequately aligned with the tax is key. I would end up saying that typical things you should look at is where you have a centralization versus a decentralized model, supply chain restructuring, financial requirements, even IT systems requirements, location of IP. Of course, here you should always follow arm's length transfer pricing guidelines, substance of a form, and governance aspects. And I guess that's all from.
Okay, thanks, Jesus. So very quickly, we have talked about this. Obviously, today's presentation really has a corporate focus, even though we've already mentioned other taxes. Please don't forget them. So if you're looking at to sort out your model, your operating model from a corporate tax perspective, you're likely to have indirect tax and payroll tax implications associated with that, depending on commercially how you're operating. Depending on the sector that you're in, you may be able to access specific incentive regimes. Don't forget about those, because that might drive some commercial decisions depending upon what the reliefs available are locally. And also, there are some special regimes. So in particular, there are special property regimes. So if we look at Spain and if we look at the UK, it's quite important to understand how the different rules can impact you. We could obviously talk a lot about those things today, but I'm also conscious that Farhan, I think, is desperate to talk to you all about transfer pricing. So I think we'll move on from this slide, and I'll hand over to Farhan.
Okay, thanks, Catherine. Thanks, Jesus. Okay, so if we move to the next slide, just setting the context. I'll briefly cover what is transfer pricing and why it is so important now for multinationals. Well, what is it? Well, clearly, transfer pricing applies to intra-group transactions, whether it's goods, services, use of IP or financing. It applies certainly cross-border, normally domestically as well. And the key point is it's designed to ensure that transactions take place at arm's length, because otherwise there's clearly scope for multinationals at their discretion to manipulate pricing to essentially engineer tax preferred outcomes, and tax authorities are clearly very aware of these practices and they scrutinize and take action accordingly. So what does that mean? It means clearly we've got UK and Spanish multinationals on the call. You will have companies and entities, particularly branches in other jurisdictions. So those intercompany and intra-entity flows all are subject to TP. What else does it mean? Clearly, you have to comply with domestic TP rules. So not only those in the UK and the counterparty if it's Spain, but also UK and Spain multinationals which are transacting with other jurisdictions as well. The risk is, if falling foul of these rules, there's not only risk of tax adjustments and penalties and documentation, but it really can act as a drain on management time and resources. And it's not good for anyone, particularly in a very tax transparent environment, and the reputational priorities of multinationals now to be seen to be good corporate citizens and fair taxpayers. Next slide, please. So just putting that into context, in practice, clearly, you'd want to be comfortable that as you do audits, as you do tax returns, that you've considered TP. So what are the intercompany flows? How have they been priced? Is there support around those pricing? Is there intercompany agreements? Is there TP documentation? All of these are important facets of how TP model and a defense strategy works, especially in the current environment. Next slide, please. So if we just elaborate on, well, what are the UK and Spanish TP obligations, and then I'll touch more deeply on what that means given the current economic environment. Well, clearly, UK, I will cover, and then I'll pass over to Jesus to cover Spain. But in the UK, we do apply TP rules. They're in domestic legislation. We apply the arm's length principle. We follow the OECD guidelines. And that applies certainly in terms of TP documentation, which applies to large multinationals. A question I often get asked is, well, what about SMEs? Clearly, we're not at the top end of the market in size. Hopefully, we'll get there one day. But today, we're still relatively small. Do we really care? Short answer to that is, unless you're very small in the UK, you have an exemption. But even then, that exemption doesn't apply if you're transacting with a country with a non-appropriate discrimination clause in a tax treaty. And so, sorry, if you could stay on the slide, please. If you could go back one.
Sorry.
Thank you. So what does it mean? It means that if you're medium-sized, you're still caught by transfer pricing rules, certainly. And even large and even small can be. So just because you don't have TPD, which I know often becomes a discussion point, doesn't mean that you're not caught. You're still caught. And in an audit, HMRC can request records and support for intercompany pricing and charges, because clearly those are impacting how much tax is being reported in the UK and overseas. The clear driver for HMRC and clearly in Spain is, has there been a reduction in UK tax or Spanish tax, or has there been a tax benefit? In other words, if you've overbooked losses. So it's not all about profits, it can be about losses. If losses are being overstated through intercompany transactions, they can be subject to adjustment equally. If a demand gets made, then clearly the expectation is that within 30 days, a company is able to provide appropriate records and support, including documentation, to defend its intercompany pricing in the UK. I'll pass over to Jesus to cover the Spanish aspect.
Thanks, Farhan. Yeah, we also follow arm's length principles. We follow OECD transfer pricing guidelines. In terms of documentation requirements, distinction is between groups of companies with more than 55 million euros of revenue. Those are obliged to have a master file. If the group revenue is within the 45 million and 10 million threshold, then a local file only will be required. And then all entities should file, even entities below the 10 million threshold should file a specific form, which is Form 232, disclosing the main intragroup transactions. Master file and local file will be filed upon request, and the standard form should be filed, let's say, after 10 months after closing, the month after. Yeah. And also we have a TP penalty regime in case of breach of such rules.
Yeah, thanks, Jesus. Just one additional point. Clearly, UK and Spanish multinationals will have operations often in other jurisdictions. So if you're dealing with the US, if you're dealing with Asia Pac, if you're dealing with Middle East, each territory has its own requirements. So these thresholds can be much lower. So if you're transacting in those markets, it's always important to just go back to the local regs, because you might have a local file master file obligation, notwithstanding you're well below these numbers. And that certainly applies in markets and clients I've worked with. Next slide, please. So what does it mean in the current economic environment? Well, clearly we've come out of COVID, we've got high inflation, there's low growth, there's business disruption. So the commercial and economic drivers in the current market are out of sync, and they are clearly turbulent to what we've seen, relatively stable past economic conditions. What does that mean? It means with economic conditions change, TP impacts arise. So just as companies are subject to adjusting prices with their customers in this environment, that has a knock-on impact back through the supply chain, through those intercompany flows. And those disruptions can happen in many different ways and through different entities. So you might have unusual costs So certainly in COVID, we saw that. Certainly in the current environment where we get high inflation, we see that. You might have less liquidity in certain entities. You might have thin cap issues. You might have workforce displacement or retrenchment issues. Or you might have potential business restructuring scenarios where you're having to scale teams up or scale them back or shift people around a multinational just to kind of adapt to the current environment. So as soon as there are changes within the business, which are significant, that means those intercompany flows and how they're being priced are also probably going to change, or certainly their pricing will change. And that happens in a real-time basis. And that's often one of the challenges, because sometimes people only tend to think about this at the year end when they're doing the financial statements or they're getting ready to file the tax return, but actually TP works in real time because prices should be in sync with the economic conditions through the economic cycle and annually. So, next slide, please. As we see these conditions in the current environment, what does that really mean when you get right through to the key points of global business operating models and multinationals? Well, often most business models and tax structures have what's often referred to as limited risk entities. There may be contract manufacturers, there may be routine distributors, there may be R&D entities, which are set margin entities, and they're entitled normally to a limited return because they don't bear key entrepreneurial risk. Of course, in the current environment, limited risk doesn't mean then they have no risk. If you have exceptional costs and if you have strain in the supply chain, you have to really start understanding who should be bearing these costs. Should margins get eroded, or should they stay the same? So classic in COVID, classic in the current environment, if sales entities are getting margin pressure because sales are more difficult and clearly prices are getting squeezed and customers, does that mean you report the same amount of income and profits effectively in that entity, or can you reduce the margin of that entity into TP because it's an intercompany and if it's sourcing services and goods from elsewhere? Clearly, we can revisit those pricing points. And to do that, a key aspect of it is what's referred to as a comparability analysis, which essentially means understanding what's changed in the business, what's changed in the market, how do we think those prices and those transactions currently hold, and do we need to make potential adjustments so that they're more in sync with the current economic conditions? So I've worked with many companies during COVID and beyond, and clearly these are the key discussion points that we often enter into. Next slide, please. So what are the options? Well, two big scenario options is one is to whether retain and operate within the existing global or tax operating model, or actually to start revising and changing it. And it's not a binary choice, and it's quite a nuanced analysis. But the one option would simply mean making incremental adjustments or trying to operate within an existing framework. And so scenarios could be things such as looking at intercompany agreements and extraordinary event clauses, just trying to justify economic arguments for why losses have arisen or prices and margins are getting squeezed, and hence income and profits are being reported at a lower level than they have been in prior years. It might be looking at loss-making comparables in the market. So what's happening in the industry and in the peers and competitors? Are they seeing similar price pressures? Again, that's strong, credible evidence and revisiting pricing. You can be looking at existing benchmarks, right? Benchmarks typically have a range. Where are you targeting in the range? And there can be specific adjustments for industry sectors. So all of those things should be flowing into record keeping and potentially updating master file and local files. If operating within the existing TP structure is just too onerous and it's just not the right choice, we can also revisit and reprice more significantly those intercompany flows. That might mean, for instance, looking at contingent payments, looking at royalty structures or flexible payment terms, looking at profit splits. So you start to wind down existing transactions which are essentially becoming out of date and not applicable as business has evolved, or you're looking at new intercompany pricing and transactions. And all of that, again, flows through to revised TP documentation and company agreements. What's the objective of all of this? Clearly, the key driver is you don't want to be overpaying tax when you don't have to be, and you clearly don't want to be underreporting. And actually, the answer to that question, they're just two sides of the same coin. Because in any intercompany transaction, you've got two jurisdictions and counterparties. So if you're over-reporting in one place, you're probably under-reporting in the other, and getting that balance is essential. Next slide, please. So what are the benefits of a TP and tax reporting strategy? Well, clearly, if you have up-to-date policies in real time and current economic conditions, you're much more accurate in terms of what you're booking as income and profits in markets. That means you'll be more efficient. You've got less risk of adjustment, tax audits coming through. You're much more likely to have better documentation and defense in an audit. As you go through the audit, as you submit your tax returns, you'll stand in much better stead with tax authorities, because if they ask for these records, you'll be able to substantiate them rather than trying to backfill. And it's just much more better for the business, because the business knows its tax structure and it knows its operating model and its pricing much more clearly, so that as changes come on the horizon or business ideas and options are being explored, you can clearly model and impact those much more effectively. Let me pause there, because I think I'd just like to thank obviously Jesus and Catherine for their comments as well. If they've got any additional comments, I'd ask them to make them, or we could open the floor to questions.
I think, looking at the time, I think we should probably open for questions. So I can see we've had a few come through. So just bear with me 1 second. And if we don't get to your question, we will respond after the webinar. Okay, so let me start. So thank you for this one. I've got a technology company in Spain. My CEO is getting married and they're going to relocate to the UK. What impact is that going to have? Well, I appreciate we can't give you a full answer, but let's keep it high level. So obviously, CEO, part of the C-suite. So we're not talking about a lower level grade employee. This is somebody right at the top end of the company in a managerial position. So that relocation is going to have an impact on the corporation tax piece. So going back to what we talked about earlier, and we have to think about triggering a permanent establishment. So it's likely that we're going to create a place of management here in the UK as a result of that individual permanently relocating here. Of course, they may do some travel. So they may become, I guess they'll become a UK tax resident, probably. But they may still have some global travel as part of their job. But we're fundamentally looking at where's their key base, and do we think we trigger a PE in the UK? So on the assumption that that's yes, I guess there's a wider question to have to understand, which we haven't covered today, and that is how do you actually deal with that? So what wrapper do you put that in the UK? Commonly, I guess you might have a subsidiary, or you may choose to have a branch, which is slightly less informal. But broadly, from a tax profile perspective, you're going to end up in the same place. Of course, need to think other things to think about will be how do you deal with that relocation from a personal perspective. So the impact of the payroll taxes, which is quite important, and any package that you're trying to provide. Farhan, I don't know whether you want to just maybe add on the TP angle to that.
Yeah, sure. So I mean, clearly, if it's the CEO, he's a key employee, so it's key decision right, and he's probably a clear value driver. So typically, groups tend to look at these arrangements as they owe a cost plus. So it's a set margin return, but actually, as soon as you start talking about C-suite, that can change very dramatically, because arguably you're into what's referred to as a profit split, which basically means you're more likely to have an attribution of income and profits in the jurisdiction rather than a set margin return.
Okay, we'll try and clear as many of these as we can very quickly. Jesus, do you want to take one?
Yeah, I'll take one. Let me see here. Okay, I'll take this one. I understand that the rate of corporation tax in the UK and Spain is the same. So ultimately, we can be completely flexible how we operate from a tax perspective. Somehow we've tackled also this before. It's true that you have a same corporate tax rate, but there are many other aspects you should look at. So, for instance, how the profits allocate to one entity or the other. If you have cross-border transactions, you have to look into potential withholding taxes, of course, transfer pricing aspects, of course, cash-trapped potential situations. You will also need to structure in an efficient way from a VAT perspective. So also sometimes we forget that also we can have negative impacts from an indirect taxation perspective. And also in terms of why not compliance burden. So also we have to look which setup is more efficient from a purely compliance perspective. So basically that will be it. Faham, not sure if we want to also pick another one.
Yeah, I'd also just like to pick up the question that's come through. I think an apology if we don't get around to every question. We will provide our contact details at the end should people wish to contact us. So I think it's an important question that's come through. And just recapping briefly, it's if I have a parent company in Spain and a branch in the UK, and the UK branch qualifies as small and meets the requirements and small as under the OECD definition, does that mean I'm exempt from TP under UK legislation? So there's, the way to think about that, I would say, is twofold. So firstly, you do need to think about clearly, you'd probably qualify small under the SME exemption in the UK, but you'd have to ask the same question from a Spanish perspective, because you may not get the same benefit in Spain, in which case you've effectively been caught by TP because the counterparty jurisdiction has a different set of criteria. And that can be true whether you're transacting with Spain or any other market, as I touched on earlier. The other key point I'd mention is, even though if you're small, you're still transacting in quantums, and those pricing and the margins can be out of sync, which means if they're out of sync in one transaction, it can actually distort income and profits, notwithstanding the legislation. And actually, those transactions clearly, groups don't typically transact with one party. They have multiple transactions across different jurisdictions. And it's not a good benchmark, because if you're out of sync in one, you're probably applying the wrong metrics and the economic principles, and so that other transactions are out of sync as well. So that would give you, a level of comfort from a very narrow perspective in the UK. But I would encourage people to just think about, the broader picture and the global structure, because clearly those dynamics can impact a group adversely.
Okay, so I think we're pretty much out of time for today.
Yeah, I think we ran out of time.
Sorry, because I think there's a few more questions that we'd like to cover.
It was a very interesting session. I didn't want to stop you because it was really interesting. So for all the attendees, we will be sharing the panelist details via email later this morning. So if you have more questions, you'll be able to contact them directly. So no worries. So I just wanted to thank you, Farham, Catherine, Jesus, and PKF for collaborating with us today. It was a fantastic session, and thank you for attending to all the attendees this morning. So just to finish, if you want to attend to any event of the chamber, if you have any chamber question, chamber related question, just feel free to check our website, contacting any colleague from the chamber, and let us know. We will be happy to have you in one of our events or in the chamber. So thank you very much for attending this webinar today, and enjoy the rest of the day. Bye. Thank you.
Thanks. Bye.
Thank you, everyone.